What the F? Like, this is just disingenuous, but this is the kind of stuff that's just circulating on YouTube right now, and I feel like we have to start addressing other content like this head on. And I want your opinion on this. So that's the question for this video, is should we be bear hunting and taking apart posts like this? I saw this post that was circulating, and basically what somebody did is they took a chart of the S&P 500, they drew a little gradient layer, and they said as long as the S&P 500 is way up here, it's overvalued. No rational explanation at all as to why a higher price means the S&P 500 is overvalued. In fact, misinterpreting earnings of companies that they had been mentioning. But let's just focus on this S&P 500 chart. This simply lays a gradient of orange over higher price levels, which means if we were to zoom in right before the pandemic and in the prior 10 years before the pandemic, since the Great Recession right here, the stock market would have been overvalued at basically every single point of the last 10 years, according to their metric. Here's a stat for you, which obviously that would be stupid. If you had missed out the stock market in the last 10 years, well, then you really messed up. But how about this? How about we look at real data? Like, let's inflation adjust the S&P 500. Let's compare the November 2021 peak to what it actually looks like when we inflation adjust it, thanks to the inflation we've seen. Because remember that inflation drives higher earnings, which then those higher earnings, even if they're from inflation, lower multiples and mean the S&P 500 could go higher. So technically, the S&P 500 should be substantially higher thanks to the inflation that we've seen from our November 2021 peak. And it actually goes to show that we're still trading at about a 20% discount from where we are on the S&P 500 in inflation-adjusted terms. Now, am I here trying to shill the stock market to say, oh, it needs to go to all-time new highs? No, there's going to be volatility. This is why I've been talking about the Nike swoosh recovery. That would be a volatile Nike swoosh recovery. But let's make it clear. We don't want disingenuous information circulating without at least a counter argument. And that's what I'm proposing. I'm proposing, should I go through these other videos and make reactions, more in-depth reactions to them, and break down, hey, look, this is where they have a point. This is where the market could collapse. But this, and this is disingenuous to the audience watching videos. Like, there's so many other examples. I don't really want to go to them now. I'll do that in a different video. But let me know, because in my opinion, we should look at real data and real earnings and not simply disingenuously color code a chart and say, see, look, the S&P 500 is overvalued. Look, I have a chart, and move on. Now, that might be what the popular sentiment is. Maybe the popular sentiment is, oh, the S&P 500 is overvalued. That's fine. But popular sentiment doesn't align with facts. Let me know what you think.
Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by artificial intelligence. If you can master AI by starting on the ground floor, let's go.